Welcome to The Pulse from 10-Minute Money Mindset. 5 weeks in a row. That is how long American investors have watched their portfolios fall. The Dow Jones Industrial Average is officially in correction. The Nasdaq is down 13%. And a new report says $1.5 trillion in U.S. household wealth has disappeared in 60 days. This is not a bad week. This is a sustained, data-documented decline with a clear cause, clear victims, and a set of economic forces that are still in motion. This Monday, we report on exactly what is happening, what the numbers mean at street level, and what the picture looks like right now for the tens of millions of Americans with money in the market. This Friday on Mind Over Money, we go one layer deeper into the psychology of why market corrections cost people more than the market drop itself. That episode will make a lot more sense after this one. Let's get into it. $1.5 trillion. That is how much U.S. household wealth has evaporated in the first quarter of 2026 alone. Not paper gains from some speculative corner of the market. Real wealth, retirement accounts, brokerage accounts, the kind of money people were counting on, gone in 60 days. Here is what happened, and here is what it means for the tens of millions of Americans who opened their investment apps this week and read the story behind the number. On Friday, March 27th, the Dow Jones Industrial Average fell 793 points. It closed at 45,166. That single day pushed the Dow past the 10% decline threshold from its February record high. That is the formal definition of a correction. The S&P 500 fell 1.7% to close at 6,368, its lowest level in 7 months. The Nasdaq dropped 2.1% and is now 13% below its January peak. Those are not just numbers on a screen. Each point represents retirement savings, college funds, small business reserves held in brokerage accounts across the country. And this was not one bad week. The Dow and the S&P 500 have now fallen for 5 weeks in a row, the longest streak of consecutive weekly losses in nearly 4 years. The last time this happened was during Russia's invasion of Ukraine in 2022. The week before that, it was a 40-year inflation shock. This is not normal market noise. This is a sustained decline with a clear cause. The cause is oil. On February 28th, the United States and Israel launched direct military strikes on Iran. Iran responded by targeting U.S. allies in the region and effectively closing the Strait of Hormuz, the narrow waterway through which approximately 20% of the world's oil and liquefied natural gas travels. When that corridor goes dark, energy markets do not wait for clarity. They reprice immediately. Brent crude has climbed above $105 a barrel. West Texas Intermediate crossed $100. Just 6 weeks ago, those numbers were roughly $70. Glenn Smith, Chief Investment Officer at GD's Wealth Management, put it plainly this week. He said, "The stock market is still highly correlated to oil prices. As oil prices move higher, stocks are moving lower. That is the mechanism." Now here is the scale of the damage. The data layer. The Magnificent Seven technology stocks, the group that drove the majority of the 2024 and 2025 bull market gains, lost more than $330 billion in market capitalization on Friday alone, in one trading session. The Nasdaq is now almost 13% below its record set in January. The broader S&P 500 is down roughly 7% year-to-date. Coming into 2026, analysts had forecast continued gains. None of those forecasts included a war. Bond markets are telling a parallel story. The 10-year Treasury yield hit 4.48% on Friday, its highest level since July 2025. The 30-year Treasury yield briefly touched 5%, a key psychological threshold, before pulling back slightly. When yields rise, the cost of borrowing rises with them. Mortgage rates are already responding. Freddie Mac reported this week that the average 30-year fixed mortgage jumped 16 basis points to 6.38%. The 15-year rate is approaching 5.75%. For a family buying a median-priced home today versus 18 months ago, that difference translates to roughly $300 additional per month. Every month for 30 years. Consumer sentiment is collapsing under the weight of all of it. The University of Michigan's final March Consumer Sentiment Survey came in at 53.3. Economists had forecast 54.0. The survey's director, Joanne Shu, noted that the reading fell into the bottom first percentile of the survey's entire recorded history. She specifically called out that consumers with middle and higher incomes and stock wealth exhibited particularly large drops in sentiment. One-year inflation expectations jumped to 3.8%, up from 3.4% in February. And then there are the jobs numbers. The February employment report landed last week with a number nobody was ready for. The US economy lost 92,000 jobs in February. Not gained, lost. Economists had forecast a gain of 59,000. The unemployment rate ticked up to 4.4%. The Atlanta Federal Reserve's GDP tracker has revised first quarter growth down to less than 1%. Full-year GDP estimates have been cut from 1.4% to 0.7%. Pantheon Macroeconomics published a report this week projecting that the $1.5 trillion evaporation in household wealth will shave at least $50 billion off US consumer spending in the first half of 2026 alone. Economists call this the negative wealth effect. When people feel poorer, they spend less. When spending falls, the economy slows. When the economy slows, companies cut. The spiral has a name and a well-documented history. Moody's AI-driven recession model, back-tested against 80 years of data, currently puts the probability of a US recession at 49%. That reading was compiled before the full economic impact of the Iran conflict hit the data. The number will be updated. It will almost certainly move. The human layer. Rob Williams is the managing director of financial planning at Charles Schwab. He told reporters this week that his firm has seen increased calls with questions and concerns and, his word, increased angst from retirement savers. He said, "The tendency as an investor is to say, yes, I want to take cover." Professor Benedict Gutman-Kenny, who teaches finance at Rice University, described what he is watching in real time among ordinary investors. He said the common thinking right now is the stock market is falling. I want to get out before it falls further and I lose more money. Then he added something worth repeating. A fantastic way to lose money, he said, is to sell in a panic. The people most affected are not just day traders or hedge funds. They are the 70 million Americans who hold 401k accounts. They are the retirees who are drawing down accounts that were at all-time highs 60 days ago. They are the 35-year-olds who looked at their balance last night for the first time in months and felt the floor shift beneath them. And they are not all reacting the same way. Some are frozen, some are calling brokers, some are quietly logging in and hitting sell. Here is what makes this moment different from a routine correction. Every single US recession since World War II, with the sole exception of COVID, was preceded by a spike in energy prices. Every one. Oil is not a commodity at the margin. It is the circulatory system of the economy. When it gets expensive, everything costs more. Transport, manufacturing, food, heating. The whole cost structure of the economy shifts upwards simultaneously. And when that happens, the Federal Reserve faces a choice with no good options. Cut rates to stimulate growth and risk adding fuel to inflation that is already running at 3.8%. Hold rates or raise them and watch the economy contract further. That combination of rising inflation and slowing growth has a name: stagflation. It defined the 1970s. The Fed eventually broke it with interest rates so high they triggered the most severe recession since the Great Depression. The medicine was almost as painful as the disease. Jerome Powell's term as Federal Reserve Chair ends in May 2026. The market does not know who replaces him. That uncertainty sits on top of everything else. The CME Fed Watch tool now shows more than a 50% probability of a rate hike in the second quarter of this year. The market is pricing in pain, not panic as pain. 60 days ago, US household wealth hit a record $181.6 trillion. It felt permanent. It felt like the new normal. It took 60 days to erase $1.5 trillion of it. That is not a commentary on what you should do with your money. This is not that show. That is just what markets do. They do not care about your timeline. They do not respond to need. They respond to information. Right now, the information says oil is expensive, growth is slowing, and uncertainty has taken over the room. What history says is that corrections end. What it does not say is when, and what you do between now and then will matter more than the correction itself. This Friday on Mind Over Money, we are going to talk about the one cognitive bias that research shows is costing investors more money right now than the correction itself. It is not fear, it is something more specific, more invisible. And once you understand it, you will never look at your portfolio balance the same way again. Subscribe so you hear it the moment it drops.